Well, thank you, everybody, and welcome to today's webinar on ASOP 4, what pensions should know about the newly required LDROM disclosure. My name is Hank Kim, and I'm the Executive Director and Counsel for the National Conference on Public Employee Retirement Systems. NCPERS is, with approximately 500 plan sponsors and stakeholder members, is a unique network of public pension trustees, administrators, public officials, and investment professionals who collectively oversee more than $4 trillion of retirement funds managed on behalf of 7 million retirees and nearly 15 million public servants. Founded in 1941, we are a 501c3 nonprofit that's the principal trade association working to promote and protect pensions by focusing on advocacy, research, and education for the benefit of public plan stakeholders. Today's webinar, as I mentioned, will cover the revisions to the Actuarial Standard of Practice 4, or AKA ASOP 4. To break the ice and get a sense of the audience and foster an interactive web experience, we'll begin with a short poll. Okay, so good answer. It seems like many of us are already starting down this road. For those who may not be familiar, and just to refresh the recollection of those who are, as of February of this year, the Actuarial Standards Board requires a new disclosure, the Low Default Risk Obligation Measure, or LDROM, that will affect future actuarial valuations. Specifically, we will provide background and context to the revisions of ASOP 4, an overview of the ASOP 4 Toolkit, measuring pension obligation and LDROM, and commentary on ASOP 4 from a practitioner and our friends at GFOA. We've assembled an excellent panel today to lead our discussion. Paul Angelo, Senior Vice President and Actuary at Segal, will provide the background and introduce us to ASOP 4. Then Dan Doonan, Executive Director of the National Institute on Retirement Security, will talk about the formation of ASOP 4 work group and the toolkit we developed. Then Debby Cherney, CEO of the San Bernardino County Employees Retirement Association, and Emily Brock, Director of Federal Liaison Center at the Government Finance Officers Association, will each provide their commentary and observations on ASOP 4 and the toolkit, and then help us kick off the Q&A portion of the webinar. Each of the panelists' full bios are available in the chat function. As we noted with the poll, we do encourage audience participation. Each of the panelists do welcome questions from the audience, so please submit your questions by using the Q&A function. Your questions will be answered near the end of the session. There is going to be a presentation in the first half. For those who are wondering, the presentation is also available on the platform, or I'm sorry, we'll be emailing out the presentation to the attendees that have registered after the session. So with that quick introduction, let me turn it over to Paul to get us started.
Very good. Thank you, Hank. Let me get the slides up here. Can everybody see those? Is that a yes? Very good. So as Hank indicated, this is talking about ASOP 4. Actuaries love acronyms, and as Hank said, ASOP means Actuarial Standard of Practice. Now, what are these things? Well, a little bit about the actuarial profession. We are a self-governed, self-regulated profession, but we do have qualification standards. We have a code of professional conduct, and we have a standards board that issues exposure drafts and final versions of these actuarial standards of practice. There are over 50 of these. They cover all areas of actuarial practice: pensions, life insurance, casualty, everything. And so there's also a group called the ABCD. How's that for an acronym? The Actuarial Board of Counseling and Discipline, that actually is sort of the enforcement wing of the actuarial profession. Now, I was asked to do a little bit of history on how we got to this point, and if anyone has been following this issue for the last 14 years, that's a dangerous thing to let me do, but I'll try to keep it short. There is a controversy over how public pension systems should value their liabilities, and it has to do with there are two fundamentally different ways to set the discount rate. Discount rate is how you turn all the projected benefits into a value today, and that's really how you measure an actuarial liability. Actuaries, public pension actuaries favor a discount rate based on what you think the fund is going to earn. So it's your long-term expected earnings. It measures an offset to the cost of the benefit. You may be familiar with the meme C plus I equals B plus E, contributions plus investment income equals benefit payments plus expenses. And the idea is if you want to know what your expected cost is, you have to have a discount rate based on your expected return. This is currently used not only for funding, but also used for financial reporting under the rules issued by the GASB, the Government Accounting Standards Board. The other school are generally referred to as market economists or financial economists. You'll hear people talk about the FE debate. They say no, that every transaction, every exchange value should be valued using a market discount rate. So we'll call this the market pricing model. This measures the theoretical market price. It is unrelated to the asset allocation, independent of your asset allocation, independent of what you think the fund is going to earn. And the way this model works is if you go out and issue a bond, if it's a risky bond, a junk bond, you have a high discount rate. If it's a treasury, you have a low discount rate based on the default risk. And that's why the word default shows up in LDROM. So they're saying that because public pensions are very reliable, they have a low default risk, then the market would price them using a very low, what's called risk-free discount rate. That doesn't mean there's no risk. It means it's what the market would price an obligation that has very low default risk. And again, that shows up in the name of the LDROM. So this is the debate that has been going on. It really does date back to around 2007. There's a lot of stuff happened between 2007 and 2013. And 2013 was when we bring the Actuarial Standards of Practice into the picture. So here is the name of ASOP 4. Its official name is Measuring Pension Obligations and Determining Pension Plan Costs or Contributions. For pension plans, this is sort of the mother of all ASOPs. It was last revised in December of 2013 following an exhaustive process. The FE folks, the financial economists, wanted the Standards Board to either require or at least define a market-based measure. The Standards Board declined to do so. Instead, they focus on the purpose of the measurement, which actually we public folks really like because we think that if you're doing ongoing funding, the purpose is ongoing funding, then the appropriate discount rate is that expected return. But they did not stop. There was a Standards Board, ASB, Actuarial Standards Board activity from 2014 to 2016, initially just looking at public pensions, but they had hearings, they had requests for comments, and then they put together a task force, a pension task force, to review all those comments. Well, in 2016, that pension task force issued their report, and it had a series of suggestions that should be incorporated into the actuarial standards for all plans. And one of those suggestions was that all plans should be required to disclose a financial economics measure, which is called solvency value in the financial economic literature. So they then went through a round of exposure drafts. These apply to all pensions, not just public sector pensions, and they incorporated all of the pension task force suggestions, including this market pricing measure. However, in the evolution of the standards and the exposure drafts, what they actually ended up changing the name from solvency value to what we're now calling the low default risk obligation measure of LDROM. And as Hank indicated, this is effective for any actual valuations or reports issued on or after February 15th, 2023. So generally, if you're a June 30 plan, it'll be June 30, 2023. If you're a calendar year plan, it'll be December 31, 2023. So what is this thing? What is this low default risk obligation measure? It's a required disclosure in all funding valuation reports, not your GASB reports, not cost studies, at most once a year. And you must use a market discount rate derived from low default risk fixed income securities, here we go, whose cash flows are reasonably consistent with the expected pattern of benefits. It's as though you went out into the market to settle your obligation using low default risk fixed income securities. Such securities include treasuries, highly rated municipal bonds, or highly rated corporate bonds. Now, here's the key part, and this gets into the actual weeds, but it's really important. The financial economic guys, they actually measure liabilities by freezing benefits, freezing salaries, freezing service, and it's an accrued benefit measure. So it's as though you're going to settle the plan. But the Standards Board says that for the LDROM, you do not have to use an accrued benefit measure. You can use the same level cost method that you use for funding your plan, which generally is something called the entry age method, and it's based on projected benefits. Now, I know this sounds technical, but this is a huge concession, and we'll see why that helps when it comes to interpret what the LDROM means. There are also complications involved, any plans that have variable benefit features. It's quite tricky, and your actuary is going to have to work hard to figure those out. Now, the standard also has required commentary by the actuary. When you look in the toolkit, you'll see that there is sample language to put in your actuarial reports. It is largely based on meeting this requirement. ASOP 4 requires that the actuary disclose commentary to help the intended user understand the significance of the LDROM with respect to three things: funded status of the plan contributions, and the security of participant benefits. Now, I'm somewhat snarkily tempted to say, what if it doesn't have any significance on these things? But that's not necessarily going to get you through meeting this requirement. And again, depending on which cost method you use, that may affect how you answer these. So let's go back to now how you interpret the LDROM. And this is also very much reflected in the toolkit that Dan's going to describe. Let's assume for the moment that you are using the same cost method that you use for funding. If you do that, then basically what the LDROM is, it measures what your ongoing funding liability would be if the plan actually invested in low default risk securities. So the what if is not a settlement hypothetical, it's more what if we actually invested that way. Well, so then the key is the difference between the LDROM, and now here I broke the actuary's rule because I'm using an acronym I didn't define. AAL is your actuarial accrued liability, and that's the funding liability. So if you use that same measure for LDROM, you take the number that is already in your valuation report, your actual accrued liability, you compare that to this new number, the LDROM, and the LDROM is going to be bigger because it has a lower discount rate. But the difference between those two is the expected savings to the taxpayers from having the plan assets invested in your diversified portfolio. Or you can flip around the other way. It's what it would cost. It's the expected cost if you decided to reduce the investment risk of your plan assets down to a very low risk, the same risk that you would have with these low default risk assets. This is how it would cost to do that. So it's either the amount that you're saving by taking on a diversified portfolio, or it's the amount that it would cost you to move into entirely very safe assets. Well, that difference, I think, helps to demonstrate the economic efficiency of long-term investments by a durably sustainable pension plan. Back to C plus I equals B plus E. By investing in these assets and getting a greater I, you're able to deliver the same amount of B benefits for a lower contribution. So this is actually how we can put a positive spin on this LDROM by comparing it to your funding liability. On the other hand, there are going to be financial economist proponents who are going to say that the LDROM finally shows the true cost of the pension promise, because their complaint is when you use the risky discount rate based on your portfolio, that you are basically taking a credit in advance for the higher returns that investment risk is expected to produce, which is a true statement. And they say you shouldn't do that. So now the ASOP 4 transmittal letter, not the actual statement, but the transmittal letter, tries to address this risk, where the Standards Board actually says the calculation and disclosure of this additional measure is not intended to suggest that this is the right or true liability measure for a pension plan. And we may want to be quoting that, although we'll wait and see if the financial economists keep that in mind when they're making their statements. Well, even though this thing was released last spring, and March 25th, 2022, there was a commentary on the Reason Foundation website that included a number of statements along this line, including, quote, the new required disclosure reflects economic reality better than any currently required number. So right out of the blocks, we have folks from the financial economics perspective who are saying that this is now the number that measures the true value of the pension promise. So we will be talking, and Dan will go through it in the handout, the toolkit. We have some tools, and we think that the language that you put in your actuarial report, it'll be up to you and your actuary for each fund to see how much of a defensive position, not only talking about the good things the number can be used for, but to try to put a little fence around it to defend against it's possibly being misused by others. So with that, I'm going to hand it over to Dan, and he's going to walk us through the toolkit. Unless, Hank, you want to take any questions, interim, I'll leave that to you.
You know what? The only thing I'll do is encourage folks, if you do have questions, please use the Q&A function of Zoom, and we will read your questions near the end of the session. So, Paul, thank you for that succinct review and overview of ASOP 4. Without further ado, Dan, why don't you take it away?
Okay, thanks, Hank, and thanks to the NCPERS team, as well as my fellow panelists here. We appreciate the opportunity to come share on this topic. So I'm going to get started with why we pulled this toolkit together. First, for pension systems, this is happening. This is coming. The new disclosures are mandated in 2023 for plan years after February 15th, 2023. Since many public plans use a June 30th valuation date, we'll see the LDROM included in the valuations that are produced late this summer and beyond. As Paul's presentation noted, there may be groups that will be ready to put the LDROM forward as the true liability that we should have been using all along. Even though the Actuarial Standards Board explicitly noted that it is not meant to be that, this is meant to be an additional data point. But this will present a communications challenge for many, many individual plans. And I expect there will also be efforts to pull together a large number of plans and release reports about the entire industry, not just specific plans. So these efforts may be misleading. We felt it was important to have resources on hand so that plans don't have to waste a lot of their own time reading their own resources. So in short, this is really an effort to help you through this transition, so that you'll have some resources to refer to. And if you could go to the next slide. I think Paul has it. Yeah.
Hey, Paul, I think you're still driving. If you could advance the slide.
There we go. Perfect. Thank you. So there's really three components to the toolkit. I'm going to go more in depth on each of these later, but first there's a fact sheet that provides a bit of background, lays out what the LDROM is, what it is not, as well as some other considerations that you should know and think about as you evaluate the LDROM and have discussions around this issue. The toolkit also contains sample language for valuation reports or that plans and actuaries can use, putting this number into context, as well as two paragraphs that, like alternative paragraphs about the significance of the LDROM. And then finally, we've drafted a number of FAQs that may help address common questions that we anticipate that you might hear once the LDROM starts being published. So on the next slide, I'm going to spend the bulk of my time here. This lays out more in depth what is in the toolkit. So first, the LDROM, what is it? It is a new required disclosure. It uses essentially recent bond yields to calculate the value of liabilities instead of being based on your actual portfolio, your actual investments. So typically this will be significantly larger than the funding target. So plans will continue to fund based on their expected returns of their actual portfolio. And what that means is the LDROM would only be a realistic funding target if the plan invested entirely in high quality bonds, as the LDROM is based on that. So the difference between the plan's funding target and the LDROM really represents the savings expected to be achieved by investing in asset classes other than bonds that provide higher returns over time. And this is, in my mind, very similar to individual 401k investors expecting higher returns from their stocks than their bonds and their 401ks. And that's commonly reflected in the tools that 401k providers create to help plan participants plan for the future. So in my mind, there is a bit of an analogy there as well. So what the LDROM is not, it's not a measure of pension plan funding. The difference between the LDROM and plan assets is not the shortfall for funding. Plan funding targets are created based on the plan's actual investment mix, not this theoretical mix of bonds that will be used to create the LDROM. So we shouldn't expect plan assets to converge to the LDROM over time. In fact, the LDROM is going to be based on current bond yields, and bond yields will change over time. So this will be a bit of a moving target. If bond yields increase next year, that's going to move your funding target around. So the fact that assets do not converge over time to the LDROM is actually to be expected. So nor is the LDROM really a measure of pension health when you compare to assets. If assets are less than the LDROM, it doesn't mean the plan will be unable to make future benefit payments. And progress towards full funding is based on your actual investments. It's recalculated each year in your valuation. You make adjustments based on the funding target, the assets on hand. So the entire funding mechanism of your plan will remain the way you've been doing it based on your actual assets. The LDROM is really a theoretical measure that's going to be in addition to that data. And as Paul mentioned, this is not the true measure of plan liabilities. There very likely will be claims to that effect. The Actuarial Standards Board also, as Paul mentioned, has put language out there to counter the threat of this being used to mislead, but we do expect to hear that anyway. What else should you know from the fact sheet? Again, ASB, the Standards Board, their guidance continues to say that public plans should fund their plan using the expected return of their actual portfolio. So the way plans are doing their funding is still consistent with ASB guidance. The LDROM would only be appropriate, again, if you're in an all bond strategy. And contributions, again, determined on the funding liability, not the LDROM. So that is not changing either. Now, second, the difference between the LDROM and the funding liability is really the way this evolved. It really presents the expected savings of investing in a well-balanced portfolio. And again, the LDROM will be a volatile measure. Shifts in bond yields are going to affect the discount rate. So not only do you have the things that you pick up each year in evaluation that change, including investment returns, but bond yields will be moving around too. So there'll be even more volatility from that. So finally, on the fact sheet, the LDROM is not based on a realistic bond portfolio. The portfolio used to as a basis of creating the LDROM numbers is not very typical as far as what you see plans buying in their bond portfolios. And in addition, a lot of pension liabilities run well over 30 years. It's unlikely that pension plans could go find bonds, and especially if plans actually moved in the direction of investing in all bonds, you're not going to find that many 70-year bonds out there to make a benefit payment to someone who's 20 years old today. Those investments really just don't exist. So we would really be looking at reinvestment of those dollars over time. So it really is more of a theoretical way of looking at the liabilities. The second resource, as I mentioned, is the sample language. I'm not going to, in the interest of time, I'm not going to go through and read that. I know it's available to you, but it is an attempt for the working group to provide a brief, clear explanation that professionals can use and talk about the significance and what the LDROM really is. And, the ASOP 4 really does require some commentary to help users put this in perspective, what the number means. So as plans and actuaries work towards doing that, we wanted to have some sample language out there as a starting point to consider. And then third, we have a frequently asked questions document. This includes questions like, why do public funds invest in a diversified portfolio? And it talks about, the long investment horizons and, how that shapes decision-making on investing. Another FAQ notes that it's not realistic to settle your pension liabilities at the LDROM cost. This is a little bit more theoretical. In the real world, it doesn't mean you could just, have the dollars equal to the LDROM and your pension obligations are settled. It's a little more complicated than that. So there's another FAQ that addresses the challenges of risk-sharing plans. Paul mentioned that briefly. If you have a plan where a post-retirement benefit increase is based on the funding level, now you're sort of running your liability, assuming a much lower discount rate or return rate. So there's a question, there'll be a number of questions to address. Similar, one of those being, how do you view this? Is this more like a stress test where if the returns are low, the benefits would automatically be trimmed? Or is this really just theoretical across the board where you assume the returns are what they are and you just value the liabilities at a different interest rate? So there are going to be some challenges and some things that will need clarified, especially in risk sharing plans where benefits are linked to funding levels in some way. And on the next slide, we really owe a lot of thank yous to a great group of people that helped on this work group put these resources together. As you can see, we had 9 system directors involved, 10 actuaries from a lot of the major firms in the public plan space, 5 communication specialists, and to make sure that what we and the actuary said really makes sense to everyone, and then 8 individuals from association staff in the public plan space as well. So the group on your screen here all participated in and contributed to this effort to create these materials for you. And we really appreciate their efforts and the help to put the toolkit together. So with that said, I think maybe I should pass it back to Hank quickly, or is this going right to Debbie?
No, yeah, thanks, Dan. And let me just add my thanks to the work group. It was very much a collaborative effort over several months, and we're very happy to have provided this to our respective members and participants. I think each plan and members of our the 4 trade groups that participated, you should have each received email mailing from all of us. But if for whatever reason you don't have the toolkit, I think each of us at NIRS, NASRA, NCTR, and at NCPERS, we have a dedicated landing page on our website for you to view and download the ASOP toolkit. So why don't we begin with sort of the conversational piece or session of this webinar, and Paul, maybe we can stop sharing the screen at this point. Great. And Debbie, Emily, let me begin with you. How have you guys been sort of reacting to and preparing for ASOP 4?
Well, I can go ahead and start, Hank. GFOA, obviously, we weren't listed on the prior slide, but I do want to mention, not only does GFOA endorse the toolkit, but also we're very happy to distribute the toolkit to our 23,000 members across the country, because in the reality of things, this ASOP 4 number is actually going to, as Dan mentioned straight on, this is going to impact communications and communications of pension health to decision makers in your community. So think about the finance officers that are on the line who maybe serve on boards or have other roles with the execution of their pension plans. ASOP 4 is going to come front and center, especially to elected bodies, not just Congress, but even your local elected officials, as misinterpretation of true meaning of true measure. And so we are very, very happy of all of the work that's been put into this toolkit, and commensurately, we will be sharing it with our membership as well.
That's great, Emily. Yeah, and having the endorsement of an organization as well respected as GFOA, certainly goes a long way towards giving a validity to the toolkit. Debbie, did you have any thoughts or comments to start off?
Yeah, I just think that, when I first saw this and first became aware of it, it kind of hit me right in the stomach, because I think that we recognize that, excuse me, there are folks that do not like defined benefit plans who are very quick to glom on to that one true measure, and make use of that in talking points that then become challenging for us to defend. And I think that, to Emily's point, the more that we can talk about this, the more that we can educate the folks that are on the front lines in our state and local governments, who are going to have to talk about this potentially when they're talking about their financial statements or pension health or any other kind of conversation with their elected officials, the better off we're all going to be. And I think the toolkit has done a great job of, I call it putting the cookies on the low shelf, right? It's the stuff that we need in order to be able to say, this is what it is, this is what it isn't. These are the things that you need to care about.
Great. And again, to the audience, if you have any questions, again, please submit them using the Q&A function on this platform. So let me go back to you, Emily, and ask, in terms of plan sponsors, because LDROM is a plan level disclosure, why should they care about LDROM? How would you answer that question?
Well, the reality is, for finance officers who are many times occupying many different roles within their organization, interpretation and understanding all of the different assessments of financial data and interpreting that, whether using metaphors or otherwise, to those decision makers in their community is obviously important. If you're a plan member, if your community is a plan member, obviously you're going to have to pay attention to the valuation assessments, and at the same time, if you are a plan sponsor. In terms of making sure that you understand and can interpret and can use the metrics of LDROM to explain it for what it is, using the toolkit, being able to talk with your officials about that is certainly primary objective for GFOA.
Right. And then Debbie, let me turn to you, and then I'll open it up to Dan and Angelo, Paul as well. But what are you doing at SBCERA to educate your stakeholders, including your employer and the participants and the employee associations and retiree groups, et cetera?
Sure. Well, I think the first thing is that we really try to work with our actuaries, and in this case, that's Paul and his team, to make sure that the language in the valuation report itself is accessible, right? It's got to be understandable to people who don't speak actuary. And I think that that's something that's really important to us. It's really important to us to have that kind of clarity in the report itself, because that ultimately is the artifact of the work that's being done and the decisions that are being made by our board in setting contribution rates and the rest. So, we already make our actuarial valuations very public. We do it prior to the board even reviewing it. We'll reach out to our employers. We'll make staff available to not just the employers and their finance folks typically, or executive directors, to talk about any elements of the valuation and their expected contribution rates. But we'll also do that for, to your point, key stakeholders like key employee association or union groups who really want to understand how that affects them when they get to the bargaining table and want to talk about what's crowding out, right? Those pension contributions that may be crowding out the other things that are priorities for them. And so we really do try to help them understand what's driving changes in contribution rates. Certainly headline risks that can be picked up either in the press or by, pension foes, let's just call them what sometimes they are, folks who really have that in their crosshairs, they don't, we would like them to understand it and have a really holistic picture about it. they don't always seem to be interested in that, but that doesn't mean we shouldn't keep trying. And so if we can arm our employers and our union and other stakeholder groups with the best information that we have, then that's an extension of our ability to communicate with our communities and taxpayer groups. So, I think specifically for us this year, we'll have, not only will we disseminate the valuations as we normally do, but I think we'll have some specific information that will incorporate the elements of the toolkit to help them in understanding that. And to the extent that, they want to read it and digest it and not talk to us, that's okay. If they want to talk to us, we're going to make ourselves available, because again, I really do think that can be a great extension of our communications reach.
Great, thank you, Debbie.
Debbie, if I can also just add
Yeah.
on to that, excellent points from former GFOA board member Debbie Cherney, I've known for a very long time, and great way of sort of harnessing. One of the key points is we've known ASOP 4 has been in motion for years. This is not new to any of us on this webinar, but it's going to be new to 99% of your finance officers out there. It's going to feel sudden. It's going to feel abrupt, and to be able to utilize this toolkit in a way that allows to soften the blow, give them language. It is absolutely the right tool to reach to. If you don't know where to start, or if you already know where you are and you'd like for other people who don't know where to start to have this, highly encourage distribution of the toolkit from here.
Great, thank you. So we do have a handful of questions in. So let me start with the first one. And I think it'll go to Paul, but anybody on the panel, please feel free to jump in. Does ASOP 4 apply to fiscal costs produced by the actuary for legislative proposals improving member/retiree benefits?
No, 100 times no. It is funding valuations. It does not apply to what are sometimes called legislative letters, basically to cost studies. So no, it is in the annual funding valuation. And the key though also is it is not a measure of planned funding. And generally when you're doing those sort of legislative notes, those are looking for what is this going to cost. So it is not about planned cost. So both the format, the answer is no, and both the intent and the purpose of that measure, the answer is no.
Great, thank you. Anybody want to add to that? Nope. Okay, great. We'll go to the next question. What was the rationale behind the need for the LDROM disclosure?
Is this a recorded session? Probably is. I'm going to take that a little bit because we were as Emily mentioned, there's a lot of us that have been monitoring this. I know the GFOA has been keeping its eye on something called PEPTA, which was a legislative version of LDROM that showed up. It was like sort of a vampire bill that kept coming back. Back 10 years ago, the financial economists, were making a pitch that all pensions should be measured this way. And in 2006, the federal tax code was amended so that now corporate plans are all funded on a strict financial economic market pricing model. Then they turned their attentions to us. And what happened within the actuarial community, there was sense among some actuarial leadership that there was a reputational risk because actuaries were not, and public pension actuaries were not recognizing the financial reality of the financial economic measures. So there was a lot of debate in there. And as I mentioned, I gave a short version of that history. The first pass, the Standards Board managed to, not buy into either a single measure or a definition of measure or required measure. That was the 2013. But that pressure continued. So my admittedly partisan view is that there was a need from feel by the Actuarial Standards Board that they needed to accommodate that there are alternative measures and there's information to be gained from that. Whether that is and I believe that's a sincerely held belief, but it did happen in an environment of concern about actuaries were not telling the public actuaries were not telling the entire story. So now by having the funding measure and this other measure, it's ideally supposed to convey some idea about the risk of the plan. So one more quick comment in here. Where this number goes is important. You already have in your actuarial reports a section, a risk assessment section under a different standard of practice, ASOP 51. And ASOP 51 actually has a line in it that talks about a number like this. Take what number you've already got and redo it using, a low risk discount rate. So we think that that's a good place to put it. And I would say the more positive view on the rationale behind this was it was supposed to give another way of quantifying the effect of the plan taking on investment risk. So that's the positive spin. Negative spin is reputational risk for actuaries. Positive spin, it's another way of quantifying the risk in the plan's investment portfolio.
Hey, but Paul, just to jump in, when we do the ASOP 51 kind of stress testing within our evaluations, we purposefully pick numbers that are not real, right? We don't test if we're a 7% discount rate. We don't go here, it's 6 3/4, here's 7 1/4. We give it a wider margin to try to illustrate that. So can you speak a little bit to that? Because I think that fits here a little bit, and candidly, this year with higher bond rates, the impact of the timing of this first go round is perhaps not what it would have been had it been 2 or 3 years ago. But could you speak a little bit to how you think that might? And then I'd love to hear, sorry, Hank, to do your job, but I'd love to hear from Emily what you think is going to happen on the Hill when these numbers start to be put widely into circulation.
Yeah, the idea, again, ASOP 51 has 4 possible risk assessments that it suggests, and one of them is stress testing, where you show what if the fund earned more or less than the assumed rate. And those are the ones that most public action have been using. But they also had this one in there. I think that this is kind of an all or nothing measure. But you're right, Debbie. The challenge is it is so market based, and it has that market volatility, which is described in the toolkit. So I think that there's a reason that most public actuaries, even though they knew that this was available to them as a way of complying with ASOP 51, I don't know anybody who did it. And that's why I took a requirement to do it. So I think that the current ASOP 51 sections, for those of you who are doing quantitative measures like San Bernardino, where you show what if we earn 0, what if we earn double, those are really the things that give your decision holders a way of quantifying actual emerging risk. But this idea of, well, what if we decide to get out of the risk business? It's just such a hypothetical question. I just don't think they serve the same purpose. Even
like
though
an illusion of precision, right?
Well, or this illusion, the whole illusion of settlement too. Yeah. And I am also curious whether go back to PEPTA, and this is Emily for you. Is this going to make the PEPTA guys go away, or is this going to make the PEPTA guys say, see, now even the actuaries say that this number has some legitimacy? I don't know how that's going to go.
Well, I would say in reality, the multiple numbers trying to communicate one number, the true number. Actually, I think the reality is there's a lot of stakeholders looking at all of the different numbers, right? Everyone on this line knows that Congress isn't your stakeholder, right? There are retirees, there are current pensioners, there are, current employees who are watching these numbers. And so their interpretation of multiple numbers is really going to matter. Now, just speaking from the perspective of someone who communicates to Congress the health of pension plans, and I do want to say, with Dan, with Hank, with Janine, with all the folks who are an amazing group of public pension network on the Hill, they are not stopping. There is a relentlessness, I think, that especially about pension health and watching pension health. In fact, I was in a congressman's office the other day who literally said, pensions are the next shoe to drop, right? If they want a number that describes that, then that would be this ASOP 4 number in and of itself. And so communication of that, communication of the variety of stakeholders looking at the numbers inside of the valuation report is so important. To go back to your initial point, Paul, the Public Employee Pension Transparency Act sounds like Pepto, but it's PEPTA. Luckily has not been reintroduced. We're in a new Congress, the 118th Congress. We're lucky that it wasn't introduced last Congress, and so far not now. But the purpose of federal policy is to add a punitive impact to it. So if you don't report this way, or if you don't claim this as the one true measure, then something happens. Well, in PEPTA, of course, it was then your ability to issue debt into the markets and create infrastructure in your communities will be limited. So we run that risk of not just what is the true number and arguing esoterically, it's what is the punishment if you don't report it this way. So definitely want to defer to Dan and Hank on that if you feel the same way.
Well, I'll say a few quick words. So in terms of pure politics, the member of Congress who was the primary sponsor and author of PEPTA, he's no longer in Congress. So at least that's one positive, maybe there that, or at least ways towards PEPTA not being reintroduced. But we all know that, Congress is not like known for its originality. They go and recycle things year in and year out. So there could be an enterprising member of Congress who would like to make a name for himself or herself, and they may end up picking that up, sooner or later. Dan, any thoughts, additional comments?
Yeah, I was actually going to take a different tangent. And, I think if you're putting out a public budget, you're going to release a budget to the public, you probably don't have a good idea who's going to take that information and represent it in different ways, because there's so much there. And, openness is a good thing, but in this case, we have a pretty good sense of what they're going to focus on, what people will focus on, what they'll say about it. So I think we have an opportunity here to get ahead of this and really be thoughtful about how we present the number in the source materials. And I think that's really an important thing to think about now, before we put this out there with, a short sentence that we weren't really clear as we could have been. This is a time to really be thoughtful about how are you going to describe this number to stakeholders? And then when people start making claims that you might not agree with, you'll have something to point back to. So I think we really have a better opportunity in this situation than you do in a lot of other situations to get ahead of things.
I will say one last quick thing relative to, the one true measure, or, what is the appropriate discount rate, argument. And it's not entirely squarely relative to LDROM, but it's all in this sort of family of conversation around that. And I use this analogy, Paul, you'll appreciate this, in the SOA podcast that I recorded yesterday. But I feel like public plans are like the NFL, in that we are, the NFL plays football, but it's a small segment of the world that plays a different type of football, soccer, right? And for the NFL, the rule about offside is, the defense crosses the neutral zone before the ball is hiked. But in soccer, it's a little bit more complicated. It's a different set of rules, and it's appropriate for the more dynamic, back and forth that soccer is. And in some ways, I feel like, because we meaning the public plan is a very small segment of public or of retirement, and for actuaries, it's those who practice in our community is a small segment of actuaries at writ large, that what the rules that may apply and is appropriate for this one segment is trying to be always imposed on us. And so it's where, like, again, the offside rules for soccer, where when it's in the offensive zone and the ball is halfway closer to the goalie than the player, I'm not exactly sure, but that doesn't really apply to American football. And I think there's a reason why we use expected discount rate versus some of the other areas. So anyway, let me ask, so has the standardized data format been established? That was a question we received.
Not really. I mean, first of all, it isn't really so much a data format. It's, the data is a number. It's a single number. There is no standardized way to calculate it. Like I said, you can use either an accrued benefit method or your funding method. There's a couple of different discount rates you can pick. And the other thing that's not standardized is what you will say about it. And that's actually why the sample language, the toolkit, is so helpful. So that's actually, and by the sample language is great, because the top part, the top half of the page is what we really think everyone should say about it. And this is where we have that thing about you compare it to your funding liability, and the difference is the expected savings. We're going to have that printed up on cards and passed out at bus stations. Then below that, though, is this commentary on significance that we're required to have. And the drafters very deliberately did a long version and a short version. That's where I think each individual actuary is going to have to come up with their own idea. But no, there is no standardized format. There is not a standardized methodology, and there is not standardized language, although we do have now what's proposed in the toolkit.
We got another question. If I'm understanding this correctly, the LDROM disclosure will be included in the valuation report. Is there a GASB statement in the works that would require LDROM disclosure in the annual financial statements?
Go get him, Emily.
So I think everyone collectively smirked. That's a great question.
Yeah.
So the GASB doesn't slow down. We know that. They're in the Century Club now with over 100 statements. And obviously 6768 has been a monumental overhaul of our reporting on our financial statements. Now, understand too, GASB statements undergo periodic reviews, of which they solicit notice and comment from the communities, which includes, of course, in 6768 world, that will be actuaries' conversations, input as a part of their notice and comment period. If there's a domino to fall, this is the domino that's falling in the direction of GASB.
Anybody else want to comment?
Well, when 67, 68 were being revised, that was another 3-year process. Again, it was the same debate that we had in front of the Actuarial Standards Board, and if we won, but it was not. It wasn't a unanimous vote, and so we think that we know GASB is going through what they call a post-implementation review. That's what Emily referred to. Some of the folks on this call were involved in work groups. They're taking their time on this, but we think there is going to be ultimately a revisit. And I'm not sure what the odds are. I don't know if it's 60-40 this way or 60-40 that way, but it's close.
Okay.
My constant pitch in this area is if you don't want bad things to happen to you, you got to be engaged. Whether you're engaged through your associations or you're engaged directly, you have somebody on your team who's paying attention to this, who's vigilant about it, who's sending in letters or testifying or anything else. That's the best way that we as experts in this space can communicate the impact that these decision makers need to understand. Can't emphasize it enough. We gotta have a seat at the table, or we're getting eaten for lunch, or whatever that expression is.
No, great point, Debbie. Great point. All right, we are getting to the top of the hour, so why don't we end with this last question, and I'll ask each of you to weigh in on your response. In addition to the normal actual reports that will incorporate ASOP 4, what else should plans do to communicate the changes to stakeholders? Dan, let me start off with you. What do you think?
So I think it would make sense if you are in a community where you know who's going to be interested in this number, who's going to see it. I think it makes sense to get ahead and let people know this is coming. Again, the source materials of how this is described, what it is, I think is very important. And to be very frank, just let people know this is going to be a much larger number, right? We offer DB pensions because they're more cost efficient. This number is going to basically assume they aren't, right? Let's start with the assumption that it costs a whole lot. Even amongst conversations in different jurisdictions, you could end up in a place where if this is accepted as a true number, you're just essentially assuming pensions are inefficient, right? And comparing DB-DC, this could be a major issue because you're still going to assume DC participants invest in a broad portfolio, diversified, get higher returns. So things like that concern me. So I'll hand it over.
Right. I'll just go clockwise as people appear on my screen. So that would, for me, is Emily. You're next.
Somehow I knew I would be that person. Well, thank you, Hank. It's clear to me that obviously a plan sponsor or a plan was asking that question because the stakeholders, as you know, you refer to, the stakeholders are wide and vast in your community. So to the extent that you're able to prepare not only the finance officers and your elected officials that this information is coming, but also, like I said, current pensioners, retirees, and current employees. In some cases, it can be more colloquial to have them understand what this means, as opposed to more financial and in nature. But either way, finesse your communication in a way that helps to ground this for them, and understand too. There are no bad consequences of reporting this number. Instead, it is an obligation of the plan to continue to offer valuation reports in accordance with ASOPs. And it's a normal course of business. It just will be a whole new number that will be perpetually on the report. So it'll be a tough hill to climb in the beginning, but maintaining it throughout the foreseeable future.
Great. Debbie?
I just extend both of those comments, and that's clarity of communications is absolutely critical. It is the best thing that we can do. It's cookies on the low shelf all the time.
Great, thank you. Paul?
You know, some of our practitioners, I may have been one of them early on, really wanted to just put this number in the smallest print possible in the last page of the report where no one would find it, buried in that risk section that nobody reads anyway, right? But I think that what we're really learning from these panelists is that's not going to be an option. Folks are going to be poking around at this number, so we need to go first. But I really like, Emily, your comment is, let's not freak out over this. Let's not convey panic. It's a number that they said we got to calculate it. Here's how you can interpret it. It's on page 42 of your report. What's your next question? So I think by being clearly communicated, but also just being chill about it and just say, it's just a number, we're gonna move on. And then we wait to play defense. If someone tries to misuse the number, then we come out more aggressively. We come out aggressively from out of the gate, talking about more about what it's not than what it is. It's gonna look defensive. So maybe we just start with what it is, going back to the toolkit. We start with what it is, and then maybe we wait a little bit for the people to come in and start talking about what it's not and then return fire. I think, Emily, that will go more in with that sort of business as usual face that we want to put on.
I think really, you guys, that's really smart if you're not the person in the crosshairs.
Oh, that. Well, you can give me my number. Give me my number, Debbie. That's right. That's right.
No, and to one of Debbie's point about, constantly being proactive, I think, this, I believe our webinar is maybe the second of a number of different webinars, again, that NASRA, NCTR, NIRS will be doing. I know, Dan, you'll be speaking at our annual conference and exhibition next month on this topic. I know the number of state associations have various sessions on ASOP 4. Paul, I'm sure you and your colleagues at Segal and your colleagues at different actuarial firms are talking to your clients as well. And so, yeah, I think this is going to be an ongoing conversation, at least for the next several months, so that we can get that saturation of understanding about ASOP 4.
Yeah, I think actually at GFOA important, I think that someone, Todd Towser from Segal, who's also on GFOA Corba, is going to be talking about the LDROM. So there's going to be a lot of those talks out there. I also think that some of the actual houses are going to have pieces that you can use. But Debbie, I think we're also going to have individual systems, I think, having their actuaries and their communications people get together. And what is the SBCERA story on LDROM? We may have each system sort of doing their own version, perhaps cannibalizing other documents that are already out there. Right.
Yep. Well, with that, Paul Angelo, Emily Brock, Debbie Cherney, Dan Doonan, thank you so much for helping us educate the attendees today. And to the attendees, thank you so much for joining today's webinar. NCPERS will be hosting our next webinar on Friday, April 21st at 1 p.m. on the 2023 proxy voting season, key proxy votes for pensions to watch. Thank you, everybody. Have a great week, and we will be talking more about ASOP 4 in the coming days.
Thank
Thanks,
you.
everybody.
Thanks,
Thank you.
everybody.